Alrighty, everybody. Hello. This is your host, Carson Herlean. I'm going to be hitting in deep concepts around how to build a life insurance policy and how to build it correctly for your strategy. And this will be a deeper dive into how these policies can be designed. What I want to talk about is some different financial strategies you can use whole life for, and then how do we design the policy for those strategies. I'm looking at how can I make this policy something I can use as a bank, as a retirement plan, as a savings vehicle, as an opportunity fund, as a reservoir of capital, whatever you want to call it. In typical life insurance, if you're to pay whatever, $100 a month into life insurance, typically all of your payment goes to a death benefit, goes to the cost of life insurance coverage. We do not want to be building a policy where everything you pay into it goes to the death benefit or the cost of insurance. If we wanted life insurance, we would just get term insurance. We're looking at life insurance as an alternative asset of where we can store money. And the reason we want to store money here is because of the benefit that life insurance offers you. You can build a whole life policy where you have liquidity. You don't have to wait 5-10 years to access any. You can get access to almost everything you put into the policy immediately, right off the bat, every single year. And eventually you'll have access to more than what you're putting into the policy. If we're looking at the policy in that lens, it's now a savings vehicle. It's now an investment. You have access to it. And how we do that is by adding special riders, it's called, or additional types of premium onto the policy other than just the regular life insurance cost. A rider is an additional benefit, an optional benefit you can add on life insurance. And there's all kinds of riders you can put out on a policy. You can put a disability rider, an unemployment rider. You could put an additional death benefit on your children, terminal or chronic illnesses that you may receive in the future, long-term care, all those different additional things that aren't really focused on life insurance, but they are additional benefits that life insurance can offer you. Another type of optional rider we put on policies, this is the kind of the secret sauce to building a policy to do this strategy, is what's called paid up additions. PUAs, it stands for. A PUA is a type of premium, just like regular insurance premium, but this premium is going to be paying off the life insurance coverage, which is why it's called paid up insurance. So the PUAs pay off the insurance coverage, and because it's paid off, that means all of that premium is essentially available in cash value right away. And if you're not familiar, cash value is what you have access to leverage inside of your policy. And so the PUA premium is giving you essentially dollar for dollar cash value. That's pretty cool. And regular base whole life premium, every dollar you pay into it in the first year is all going to the cost of insurance and the death benefit. It's not giving you any cash value. But what we do to build a policy this way and maximize your cash value, give you liquidity, and have compounding interest inside of your life insurance is we use your dividend you earn every year to reinvest back in the policy and actually buy more PUA premium. That way it's buying more insurance, but giving you immediate cash value to that dividend, and then go back in the policy. That way it continues to compound interest on itself. This is the combination of these two premiums is what's really building a policy. Base and PUAs. What the base premium is, base is regular life insurance. It's a whole life premium that buys your death benefit. So this is the actual cost of the policy. And this premium is a fixed premium. It's something you'd have to do every year to keep the policy going. If you can't pay the base, you're at risk of lapsing and losing the policy. The PUA premium, totally opposite of that. Completely flexible, optional premium. Never have to do it if you don't want to. Totally can do it every year to the max if you want to. So flexibility. It's also dollar for dollar giving you cash value. Not what base premium does, but the PUA gives you immediate cash value. If we're looking at these two premiums, some might ask,
hey, why don't I just put all of my premium into the policy buying PUAs and not the base? That way I can get access to everything I put into it.
Because people are doing this strategy because they want the attributes and the benefits of what life insurance offers. Whole life insurance offers you a place to store money that's guaranteed to grow no matter what happens in the market, what happens in the world, what happens in your personal business, anything. Guaranteed to grow. You're going to earn a dividend on top of that. And these insurance companies we work with have been around for over 150 years. They have been profitable every single year they've been in business, which means they always have a dividend, which means your policy always grows. This growth is tax-free. The policy also has a death benefit attached to it to protect your family in case something happens. It has all those other additional benefits like long-term care and illness protection built into it. Those things you don't get in anything else except life insurance. From there, it also has protection and stability. If you're ever in a lawsuit, judgment, lien, and the market crashes again, you're completely safe. The policy is never going anywhere. And on top of all those things, you still have access to what you're putting into it if you build the policy right. So I can get all those things and have access to my money.
Why would I not save every single dollar I can inside of these type of policies and not keep it in a savings account or a high yield account or a bond or an annuity or even a 401k? This policy will be a better alternative to all those places.
If that's how we're looking at it, that's what we want. And people have been doing this for a very long time. These policies have been around for 200 years. And wealthy families and individuals have been using this as another place to store money for that long. People, as of recently, are still using policies to be a place to store money that's more efficient than anything else. And so people had the same question of, why can't I just pay all the PUAs into the policy, have a tiny, tiny little base, that way I can have a ton of cash value and still get all those benefits we're talking about, right? That was actually what was happening. People were stuffing tons of PUAs into policies with no real death benefit, and it was totally manipulating life insurance. The IRS stepped in actually in the 80s. They said, well,
hey, these policies look more like an investment than life insurance, so we gotta make a change for scamming you guys. Or you have to have a big enough death benefit compared to the premium you're paying into the policy.
And if you have a big enough death benefit compared to your premium, then essentially your policy should be fine. It looks like life insurance. But if you have a super big premium and a tiny little death benefit, again, you're kind of manipulating life insurance and you're not paying for the death benefit. You're just doing all PUAs. We're going to tax you in your policy as if it's an investment now. And this is called the MEC 7K rule, modified endowment contract. It's how your policy could become if you overfunded and have a small death benefit. So we want to make sure we stay within those MEC rules. When we're designing policies, we need to make sure the base premium and the PUA premium are at an amount that stays within those limits. That's what a insurance professional and a banking professional would help you do. We'd help you figure out exactly what base versus PUA splits you should do, how much premium you should put into it, and how you can really use your policy. And so that's what you want to work with somebody to figure out, is what amount of PUA versus base should you do. And so when you're picking those things, how I decide how much base versus PUAs I can do is a few different ways. And I've heard different philosophies around this. I've heard some people say, put your base premium each month as something you can just comfortably do no matter what. Easy, I could do $300 a month, right? Whatever it is. Then have your PUAs be 2, 3, 4, 5 times that. That way, throughout the year, you can just dump more PUAs in when you feel comfortable and have extra cash. That way you can really just use this as a savings vehicle, dump money in when you can. And that method makes sense. But the other way I would look at having a scheduled premium is looking at how much you need to build up in the policy for your desired retirement income. Another way you could look at it is, how much do I save every single month? Oh, I save $2,000 a month every single month, and I've been putting it in a 401k savings in Robinhood. Why don't we cut all that crap out and do $2,000 a month in the policy? Easy way to determine how much you should pay into it. Just a total premium between the base and PUAs, total amount being $2,000 a month. And then we'll maximize how much PUAs you can do compared to the base with your $2,000 a month of income you feel comfortable to put into it. And so depending on how consistent your income is, depending if you're a business owner versus a W-2 or is a 1099, everyone's income comes differently into their life. Everyone's investments are different. Everyone's risk tolerance is different. So how much you should put into a policy every year is based on you, and how much you should put towards the base versus PUAs is based on you. But that's what someone like me would help you figure out, is how to determine those amounts, how much to put into your policy. A couple more things to add on this is when you're looking at cash value and death benefit. Let's say you do $100 a year goes into whole life premium. That might give you $100,000 death. And every single year as you pay more premium, the death benefit will increase. So it's $100,000 in year 1. Year 2, you pay another $100 premium to the base. The death benefit now might be $102,000. Year 3, you put $100 in base premium. Year 3, the death benefit grows to $106,000. So on and so forth, your entire life. Based on your age and your health, obviously the death benefits compared to your premiums are different. With paid up addition premium, $100 every single year of PUA premium will also increase your death benefit. So it might give you, in year number 1, you put $100 of PUAs. Your death benefit might increase by $1,000. Remember, $100 of base gives you $100,000 of death benefit. Maybe $100 of PUAs gives you $1,000 of death benefit, maybe a little bit, maybe less. Year 2, you put another $100 of PUAs. I bet the death benefit grows another $1,500 maybe. So it's very, very small, I guess is the point I'm trying to make. Don't take those numbers for actual fact. But the PUA premium barely gives you any death benefit, whereas the base gives you a ton. Okay, fair, now we understand that. Now, how does the cash value relate to these two types of premiums? Well, the base premium will give you $0 of cash value in year 1. So $100 of base, 0 cash value. Year 2, $100 of base, $0 of cash value. Year 3, $100 of base premium. Year 3 cash value is $50. So in the third year, I put $100 of base, I get $50 of cash value. Okay, so I can access a little bit of what I was put into it that year, right? That's kind of how you'd look at it. Year 4, $100 of base premium. Cash value increases from 50 to 120. So it increased by 70. So okay, my cash value is starting to grow a little bit. That kind of increase will last your entire life. And the cash value will grow exponentially throughout your lifetime. So in year 1, every dollar of base premium gives you 0 of cash value. In year 5, every dollar of base premium probably gives you $1 of cash value. In year 10, every dollar of base premium probably gives you $1.25 of cash value. Year 20 into your policy, every dollar of base probably gives you $3 or $4 of cash value. 30, 40 years into the policy, every dollar of base premium will give you 5, 6, 7, 8 times your premium in cash value. So you're kind of seeing how that exponentially increases. You're putting $1 in and getting way more available to you in cash value. And again, remember, this is tax-free. But you have to wait many, many years before your policy can do that with the base premium. So how can we get those cash value growth long-term, but still have access to our money today? That's why the PUA rider is so efficient, because every dollar of PUA premium you pay, you're going to get $1 of cash value. That's going to be year 1, year 5, year 10, and year 50. Every dollar of PUAs gives you $1 of cash value. So it's $1 forever. Whereas the base premium gives you nothing in the beginning, and then it's slowly built, and it's efficient and continually exponentially grows. So we want enough PUA premium, of the total premium we're paying into it every year. We're getting a ton of cash value. And then there's going to be a point, maybe 5, maybe 10, maybe 7 years into the policy, where you're like, hey,
I've been paying a ton of PUAs into this to build up my cash value, but now my base premium's doing pretty dang good. Do I even need to do fakes or do I even need to do PUAs anymore?
Honestly, you can stop the PUAs whenever you feel comfortable. Just do the base from that point on. If you have more money to put into policies, then go ahead and set up a new policy. Get a new base premium starter from year 1 to get that moving, and use your new PUA contribution to go fund that one and really get that one moving. So you can manipulate your PUA premium however you want, and you just need to understand these 2 types of premiums so you best know how to use your policy and how to set it up. Now, the next thing I'm going to add is doing a one-time lump sum. You can look at this as a down payment or initial deposit or whatever you want to call it. I call it a dump in. So year 1, day 1, when you set up the policy, you can actually dump money into it. Excess of whatever the base and PUA premium is, and whatever the MEC limit you have and regulations you have, doesn't really matter. You can dump into the policy on day 1, typically 10, 20 times your base premium. You can dump a ton of PUAs into the policy to get it started, and you'll have access to all of it in cash value, right? So if you have $100,000 sitting in an annuity or something somewhere else, why not dump it all into this policy to get it started and have access to all of it right away so it's not gone and you can still use it to go do other things, but now it's in the system. Now it's going to sit here and earn interest and dividends the rest of your life. Now it's going to be tax-free. Now it's going to be protected. It's going to get all the benefits of what life insurance offers you. And so if you have money sitting in all these different places, why don't we scrounge them all together, dump it into the policy to get it started, because we're able to do this as a one-time thing. I want to take advantage of that. So this is called a single premium lump sum, a single PUA, whatever the insurance company calls it. Every insurance company has different terminology. But you can do a one-time lump sum that really gets the policy kick-started and gets the money in there. You'll notice sometimes that you need to add term insurance to the policy. And you all know what term insurance is. It's regular term premium for life insurance. But you can typically require term on your policy. This might be going too deep in the weeds. The insurance company will make you put a little bit of term onto your policy. So within your premium every year, a portion would probably have to go to term insurance if you do that big lump sum in year number 1. If you do a big lump sum, they're going to require you to increase your death benefit so that you can allow for that lump sum and you don't mech the policy. So sometimes they require term, and honestly, it's worth it to get tons of money into it up front, and it increases your death benefit for a few years, which I think everyone needs during their working years anyway, so I don't think it's a bad thing at all. But the term premium is definitely important and something to recognize, because you don't want to be confused or you're like,
Oh, I thought it was just base and PUAs. What's this term premium? Am I getting scammed?
No, you're not. It's a part of the policy. This is not something that's throwing additional fees at you. It's not like that. It's just you have to have enough death benefit for what you want to put into it. And so the easiest, cheapest way for us to build policies to do that is by adding a little bit of term sometimes. So be aware of that and understand that when that comes around. I have one more thing I want to hit. How do you manage your premiums and manage your policy every year? I'll tell you what I do. Every quarter, I go in and I look at my 4 policies that I currently have. I have 4. I know the base premium, I know the PUA premium, and I know when the premiums are going to be due. And so every quarter I come in and say, okay, what premiums do I have due this upcoming quarter? Okay, I got to make sure I have money available to pay those max premiums to make sure the base and the PUAs are paid for and get everything into it that I can. So I make sure I do that. And then I make sure if there's any PUAs I missed in the previous year, I make sure I get anything extra into the policy that I can. And then I make sure I am aware of whatever loans I have outstanding. So if I have a couple loans out on one policy, another policy, I look at total loans available and I look at my investments coming back in and I determine, okay, well, when this investment pays out, I'm going to put this much back into my policy to repay the loans. So I'm just constantly using my policy as a savings vehicle and kind of a cash flow management system for myself. And this is super powerful for business owners. If you're a business owner listening to this provides so much structure to your financial life because the cash management of a business owner sucks. People are terrible at it. Some of the guys today I went through base premium versus PUA premium, how you want to look at them, how you want to use them, what it looks like short-term and long-term, and reminding you guys to talk to your insurance professional about how to build a policy this way best for you. And as well, if you're looking to set up one of these banking policies, please reach out to me. I'd love to give you advice, ideas of what insurance companies to work with, how to set it up, what's best for you. That's what I'm here to do. That's what I do all day long is I coach people through financial or through cash management and how to be allocating these funds in certain places and how to build these policies. So please reach out to me on my Instagram, YouTube, email, whatever you want to do. But appreciate you guys listening today. I know I flew through this. I talked super fast. Thank you for listening. Maybe put me on 0.75 speed instead of normal speed or speeding it up. And I hope this was helpful. But if you do have any more questions about PUAs, base, different policy designs, please hit me up. Again, love you guys. Thank you for listening to this always. Appreciate you. We'll see you soon.